So, while we're hopefully getting the right slides, Cormac and Mark have very kindly agreed to allow me to talk about the Libra AltFi Returns Index, which we have launched this morning. The Libra AltFi Returns Index, or the LARI, as we hope you may come to know it, is the first ever comprehensive index of the industry's returns. We have taken every cash flow from every loan made by the eligible platforms since their inception. As things stand, the index is made up of 3 platforms. It's made up of Zopa, Funding Circle, and RateSetter. The index, which I hope we will be able to see in a minute, is equally time-weighted. This is very important. It is not volume-weighted. So the reason I make that distinction is that if you do a volume-weighted index, then you are vulnerable to the effects of seasoning, or as I recently heard it described, speedboating, which is the effect whereby in a fast-growing industry, old loans go bad with greater regularity than new loans, for obvious reasons. And in a fast-growing industry, you've got way more new loans than you've got old loans. So if you just have a volume-weighted index, then your return will be flattered and your default rate will be understated just because of the sheer volume of new loans that you're calculating versus the old loans. So we use an equally time-weighted approach whereby an equal notional amount of capital is applied to each quarter, and then the quarter is only de-weighted as the principal rolls off. So as the quarter ages, it's de-weighted to reflect the principal rolling off.
So it's as if you invest $1 each quarter continuously. That's the return you would get, right?
Exactly. So it's a notional amount into each quarter. The output is actually a 12-month trailing percentage return. We were very keen for this index to actually mean something to an investor. And if you think that you don't know exactly when the investment was made, a 12-month trailing return is really the only way you can represent it. But we felt it was very important to make it a percentage return because that actually means something and can be compared with other asset classes, as we'll come on to have a look at now. Just briefly, before I show you the chart, which I know is what everyone wants to see, I'm not so good at explaining things in Greek, but for those who want to look at the maths behind this, there is an extensive methodology on the site.
They can ask Sam about the mathematics behind this, I guess. Right?
Exactly. Those that know me know I don't speak Greek, but the Greeks are on the methodology. Sam knows it better than I do. Please have a look at that on the site. That's the maths methodology. And here is the index. So you can see it's very long. You know, let's not forget that this industry now has 9 years of history. Obviously, the first half of that is just Zopa, and then from 2010, they're joined by RateSetter and Funding Circle. The second observation I would make is that you know, the absolute level is impressive. So the last data point is 5.1%, and the index has bounced around between 4.5% and 6.2%. And that kind of is the third point as well, which is the consistency, which I think is at least as impressive as the level of this chart.
Rupert, can you talk about what the criteria for inclusion in the index is?
Yeah, sure. So we will be delighted to expand this index in time as appropriate. For now, as I say, it's just those big 3. And the eligibility criteria are size. The benchmark is you need to represent at least 5% of outstanding market share as measured by our volume series. That cut-off at the moment is about £150 million of lending. You need to be relatively grown up, i.e. the life of your platform needs to be 150% of your average loan life. So you need to be showing some maturity so we can actually show relevant history, so we can actually show loans that have matured and so it means something. And finally, and arguably most importantly, you have to be prepared not only to share the relevant cash flows with us, but to divulge your loan book. So to publicize your loan book on your own website, and in fact, at the moment, all of the loan books are on our website, accessible through our website.
And Rupert, when will we get to see the individual returns from each of the platforms, right? Because I guess that's what investors will be really interested in, seeing actually, you know, do I want to be putting my money into Zopa, or RateSetter, or Funding Circle?
Yeah, that's an excellent question, Cormac. You've really quite caught me out with that one. So
unrehearsed, actually.
Yeah, that's one of the most fascinating elements to this. And we are going to come on and talk about how this index is made up, specifically to Zopa, because it kind of explains and shows what's going on quite well. Clearly, we can break the lines out of the 3 lines out of that line. We're not doing that at the moment. This is the first time somebody's been able to present the historic returns of this industry. So we think it's extremely useful standalone already. In time, clearly liaising with the platforms, we're going to work out how we're going to use this information, what we're going to do with it, etc. But for now, it is an industry. It is an industry index. And actually, something I meant to mention is, as I say, this is made by aggregating all the cash flows from every loan. So it is, of course, a net return. Okay, it's the gross lending rate, net of defaults, net of fees, and then after adding back any recoveries as they come through. And Cormac has preempted my next couple of slides. So firstly, just to put the level in context, the grey line is a UK 2-year term deposit. Conveniently, the average life of our loans is about 2 years, so I think it's an appropriate benchmark. I just wanted this slide to illustrate the impressive absolute level. This is the net line, okay? This is the net return. Yes, this is an investment product, not a savings product, but ultimately, that's a pretty chunky premium you're getting off the most generous kind of savings rate that you can find, 2-year term deposit.
And any observations, having seen all the underlying data on why it's gone down for the last, that 1% fall? Anything you'd read into that?
The term deposit?
No, your AltFi
so
return.
The return line?
6 to 5%. 6% falls to 5%.
Well, it's just margin erosion.
Okay. Right? Yeah, it's a very good question. The honest answer is I don't know. But I tell you what, let's move on because we will break down a part of this line, okay, and you'll see what is going on behind it. I would agree, probably more recently, it's maybe margin erosion, albeit it's fairly stable in the last 12 months. But let's have a little look at, to illustrate the consistency of these returns, let's go and have a look at what happened in 2008. So I'm jumping forward a bit here. So 2008, we had a financial crisis, we had a recession, on some measures, worst ever recession, blah, blah, blah. We now have the history to show what this industry did over that period. Now, let's remember that the industry at the time was just Zopa, okay? And in short, Zopa performed incredibly well through this phase. So they weren't immune. Defaults did go up at Zopa in 2008, as you can see from that chart. But yet, the line stayed incredibly stable. In fact, the line actually went up through that phase. So what was going on? Yes, defaults were going up, but equally, the lending rate was going up. And aside from the fact that the lending rate compensated for the rise in defaults such that returns remained stable or even went up a bit, the other thing I think is really interesting about this line is just to recognize the responsiveness of it. So I've charted it versus a proxy for UK bank unsecured lending. Don't look at the level so much because clearly it costs more to lend from the bank and less from Zopa. We all knew that. But actually, don't look at the level because clearly Zopa is lending to high quality credits than banks on average. So it's not surprising there's a gap. But what I wanted to highlight...
It's the amount it goes up, right?
Exactly. What I wanted to highlight was the responsiveness of effectively the cost of money line at Zopa. So not only was it moving significantly before the bank proxy line, but it moved much more dynamically. It moved to compensate. And then equally, it started moderating much ahead of the UK banking line to compensate. And I thought this was really interesting when I first saw it, just on the basis that, historically, any proxy for the cost of money has been pretty questionable. Do you use base rates? Do you use gilt yields? Do you use a proxy like that? This is an incredibly pure market-based proxy for the cost of money. So that's me done in terms of charts, and now we can maybe open it up to a bit more of a proper panel discussion. I guess the last message I want to leave you with is we strongly believe that this is an incredibly impressive set of data series. Sorry, not blowing our own trumpet, on the basis that the industry now has 9 years of history, and it's really, really, really good history. It's consistent, it's stable, and the absolute level is impressive. So I hope that more platforms will join over time, and I hope it's something that, as an industry, we feel we can shout about. So, guys, thank you very much indeed for allowing me to elbow my way in and do that. Maybe now, if there's any more time, we can have more of a panel discussion.
Actually, I've got one question. Looking at these numbers here, all three of you really. Where do you think they're going to go next?
I've already talked too much.
I'll take that one. I think in the short run they'll go up as Eaglewood, Victory Park Capital, and other institutional capital comes in.
Go up?
I think they'll go up because I think there's a lot of low-hanging fruit in the near prime space. I think everyone's attacked the prime space already. Up until now, the platforms could not have really afforded to have very high loan losses because they were kind of competing to some extent with term deposits. Now there's a lot of institutional capital. I think the risk appetite rightly has greatly increased. So I think that we'll see the risk-adjusted returns average. I would predict the Libra AltFi return index will go up for a couple of years. But then as
to what? What do you think it'll go to?
I think it can go up to maybe 2%.
Additional 2% for
incremental 2%. And then I think that the wall of ISA money actually will collapse returns. I think that there's about 500-600 billion pounds of ISA money, and there's about 2 trillion pounds of pension money behind that. These, pension money's fed up getting annuity returns of 4%. That money comes into the sector. I think the risk-adjusted returns fall a lot. So you could see the index go up 2% and then down 3 or 4%. That'd be my guess.
Mark, what's your take on that?
I don't have that crystal ball. I do think that you're going to see a matching between this institutional money flowing into the sector and increased awareness, helped by some of the advertising and marketing campaigns that we've seen. If I was to guess, I'd say it stays flat at about 5%, but I don't have that crystal ball.
Rupert?
Yeah, 2 points for me. I guess the first point is to say predicting where that line will go is to some extent a function of predicting what interest rates are going to do.
Yeah.
I have a view on that, but for me, what's more interesting is predicting the margin versus a proxy. And for me, it seems likely that over time, that margin is incredibly generous at the moment, I would argue.
So the spread's going to come down.
So I would have thought the spread will come down over time. And the second point I would make, which is kind of interesting to understand, is that because it's time-weighted, yes, we avoid the effect of seasoning, speedboating, whatever you want to call it. But if there was a marked change in platform risk appetite, in the short term, that would boost the return. Because you'd be writing higher risk business, so you'd be writing higher yielding business, and defaults don't happen for a while, classically. So the net return, the netting off of the defaults, would happen a bit later. So if there was a big change in risk appetite, one way or the other, that would affect that line.
Okay. Right, these guys are going to go next door, and if you do want to find out a little bit more about the kind of investment ideas into there, and please do ask questions of these guys over in the next session, is that actually a lot of the Libra guys and a lot of the AltFi guys are in Australia, and the Australian scene is moving very, very fast. And I'm sure you guys can pick up on that theme next door. Thanks, guys. If I can ask, thank you, put your hands together for them.